afternoon, everyone. Thank you so much for joining another Barometer Readings webcast. I'm Pamela Hastings, Relationship Manager here at Barometer Capital. And joining me today, as always, is our Chief Investment Strategist, David Burrows, who will provide us with a brief macro overview at the tail end of the conversation. We will be pleased to address your questions. So don't be shy. You can email me at phastings@barometercapital.ca or hit me up on the Zoom Q&A or the chat. I also want to mention that we have a very special guest star joining us from our trading desk. James Callahan, one of our key portfolio analysts, is joining us today and will provide us with some information on AI across industries. So we're looking forward to hearing James' thoughts on that sector as it evolves. With that, I turn the conversation on this very first Tuesday of the summer to David Burrows. Good afternoon, David.
Hey, Pamela, how are you?
Great, thank you. So nice to see you.
Great to see you too, and thanks so much for moderating. Thanks everybody for joining us. Here we are coming up to the end of June, and of course that means we're about to start seeing second quarter earnings. We've been very focused, all of us, on inflation data. We've been focused on geopolitical developments that's been going on in Europe. We've been focused on China. We've been focused on global growth. Lots to think about, lots for markets to digest, and certainly, no shortage of folks telling bad news stories. The question is that what markets are reflecting, or maybe are people being a little bit too pessimistic? So we're going to just take a broad-based, high-level view as to what we're seeing as the message of the market, and where we are positioning based on the process that we use to try and stay in sync with what's going on. So just to start out, as we always do from a high level, picture the S&P. This is the bull market of the 80s and 90s, the secular bear market from 2000 to 2013, where the market effectively went nowhere. Cash flow in the S&P quadrupled, but ultimately it went from an over-owned asset to an unloved asset by the end over the course of 150 months. And then eventually you made a new high, which kicked off a new secular bull market. And that tends to be the way that it goes. Asset classes go through long bullish cycles and long bearish cycles. And of course, there's corrections and consolidations along the way. But we always want to try to build portfolios from assets that are in secular bull markets. And realistically, as much as we can make money from time to time during a secular bear market, we want to try to avoid or underown assets that are going through secular bear markets. So as it sits, we've been in a bull market since 2013. There have been lots of big corrections along the way. And certainly we've been in one since the beginning of 2022, now 18 months ago. So the S&P is still about 8% off the highs, but there's been no shortage of bad news. Concerns around recession abound. But the fact is, by October of 2022, market was down 27%, which would typically discount a typical recession. And that we know markets are not in tune, always lockstep with economic data. They tend to look ahead. Here we are now, a number of months later, and the market's been slowly working its way higher. And as we sit today, we're very close to a 52-week high in the S&P. Now, under the surface, there's things that are going right and things that are going wrong. But the fact is, we believe we're in a structural bull market in stocks. Now, last week, we highlighted that in the period between June 19 and June 27, historically, pretty tough week, and often you can get a little bit of pullback. We did have a little sloppiness in the market over the last week. And here we are now coming in on June 27th, where we tend to have a strong period through the month of July or summer rally. So what's happened? Well, we got 1, 2, 3, 4, 5, 6 down days since last week. Today, sharply higher. But that sort of follows the pattern. We talked about the fact that we were extended well above the rising moving averages, the 9-day, the 21-day, the 50-day moving average. but that we've been making a series of higher lows since October of last year. So we continue to believe that October was ultimately the low for this bear market. And while things have definitely not moved higher in a straight line, they are slowly improving underneath the surface. The NASDAQ 100, of course, has been the star since the beginning of the year. This is year-end 2023, higher low in March, higher low in April. And of course, here we are again, stretched well above the moving averages. We did come in over the last week. I'm not so sure that this is done. It may well be, but certainly a very strong trend in place. And that happens to be impacted by the fact that the very largest companies have had an inordinate impact on the market. Now, it's been a weird year. The percentage of stocks in the S&P beating the index is basically at record lows going back to 2020. So a very small number of stocks having a big impact. Looking at it another way, if we were to look at the annual contribution of the 10 biggest companies in the S&P, this year eclipses them all. 85% of all of the return in the market has come from the top 10 stocks. So it's a tough year if you're an active manager, because it's unlikely you have piled all of the money into the 10 biggest companies in the market. Very unusual. And they account for 13% of the return. So 13% positive for the S&P from the top 10 stocks. And again, this is a really significant impact. What I do think is important is that we have seen in the last couple of days strength in the equally weighted S&P 500. So like the S&P, we saw a low in October, we saw a higher low in March, we saw a higher low in May. We had a nice rally as the market broadened, pulled back over the last few days, but again, 2 sharp days higher. In fact, yesterday with the S&P down about 80 basis points, the equally weighted S&P, where you give every one of the 500 components an equal weight, was up on the day, while the market cap weighted, where the biggest companies have an impact, was down on the day. So that's positive, because we care what the average stock is doing, because realistically, the market cap weighted S&P does not typically reflect what people would have in a portfolio. They tend to have more equal weightings position by position. If we look at the TSX, it's been a lagger so far over the course of the year. It's improving in fits and starts the same way the S&P is, making higher lows, October being the low, but realistically up a very low single digit on the year, up about 2%. So the TSX has definitely been a drag. And I think that that's had to do with, some of the sector makeup. Now, we've looked at a lot of statistics since the beginning of this bear market. And a lot of them over the last number of months have been highlighting when you had strength like we've had recently, it tends to be, first of all, that the bear market's over. So when you had really bad years going back to 1950, once you're up 20% off the lows, if you looked out 6 months, in 100% of the cases, the market was up an average 18%. And 12 months later, from the point where the market was up 20, you were up another average 28%. So it matters not to get too bearish. It matters not to get too focused on the bad news. It matters to be willing to have some positions that are showing slow repair, even if they're not blasting off to make new highs. Because ultimately, in a bull market, the market broadens and brings more and more companies into the rally. So in this case, people went right back to the things that have led over the last 10 years. That may or may not be what leads over the course of the long cycle. But the fact is, we're now also seeing it broaden into other areas. Now, we talked about how global stocks have been outperforming US stocks over the last 12 months. And what's significant is that because global markets have been so weak relative to the US for many years, there's been a tremendous amount of money built up in money market funds. So in the US, there's something like $5 trillion, there's 7.8 trillion in global money market funds. That's a lot of money that's only slightly ticked down since these markets have started to rally. So markets like Japan. Now, this is not a big piece of people's portfolios. In our macro portfolio, we have a fairly sizable weight, about a 6% weight in Japan. You may have read Warren Buffett has been building up significant positions in Japanese stocks with a view that after many, many years, really undervalued and actually starting to work. So this chart just goes back to 2006, and you can see the bear market that Japan was in, and you can see what's been happening over the last 2 years. While we had a bear market in the US, there was no bear market in Japan, and certainly it's been accelerating the upside. When we look at the very long-term picture back to 1991, you can see what a futile ride it's been for Japanese investors. But we believe we've come out of a long, long bear market, and this actually could be a very strongly performing market. If global stocks have a tendency after outperforming for 12 months to keep going, it makes sense that we're breaking out of these giant bases. So that's the Nikkei, that's the Indian market, that's the Mexican market. We could look at a whole number, look at EFI, we could look at Europe, we could look at some of the South American markets like Argentina. We're seeing across the board them break out of bear markets. That's really significant because it means that they could perform well over the next 10 or 12 years. And in general, investors have thrown away exposure to global stocks in favor of US stocks. And we would suggest it might be time to be going the other way. From a structural bear market in rates or bull market in bonds, we saw a reversal in 2020. And we know that this isn't changing a lot, but we saw low in rates in 2020. We've been consolidating in 10-year yields since then above all the moving averages. These are slowly turning higher. You're digesting this big initial gain, but they're not showing any sign of weakness. Bond prices, on the other hand, aren't showing any sign of strength. Now, it's interesting because look at the money flows into fixed income and the bond market over the last 6 months. By far the biggest flows into bonds. That must be very frustrating for investors who basically are break even over the course of the year and not making any progress. So we know that the moving averages are all moving lower. We know the expectation is that a weak economic environment might lead to lower rates at some point. It's not showing up in the bond market. Bond prices are in a downtrend. If we look at the aggregate bond index, which during 2022 was down 15%, again, is really making no upward progress. In fact, it's failed to rally at the moving average and was weak again today. So we continue to think that bonds ultimately are in a bear market. Short-term bonds are really somewhere we can put money to hold, to keep some powder dry, and to wait for an opportunity to put more money to work in the market. But to be honest, we don't think that this is a great place to go for the next 3 years or 5 years. Ultimately, we think rates are slowly going to work their way higher. You can see that on this chart. Stocks, or the S&P, relative to bonds, the 10-year, is rising. It means that the relative strength of stocks versus bonds favors stocks. So stocks would be our preferred asset class here. Now, we think that we saw a generational shift in commodity prices started in 2020. We broke the trend in 2021, but a very sharp move higher. In fact, sharply higher against a bear market in stocks, and now sideways over the last number of months. So while it is frustrating to wait, my guess is we break out to the upside here. But in the meantime, the Fed has been very, very aggressive at raising rates, has done very little to knock down commodity prices relative to the move they've had off the bottom. And we know that when a relative move in commodity starts, it goes on for a long time. And we have seen a continuation come in agriculture companies. That's the wrong place. And we've seen strength in other sorts of materials. Now, the US dollar is a big linchpin. It saw its high around the time the stock market saw its low as a safe haven asset. We've seen the US dollar come off the boil, make a series of lower highs, and continues to be weak and below all the moving averages, pointing the US dollar lower, or the euro, the yen, the pound, and perhaps the Canadian dollar higher. That is friendly to more economically sensitive groups. Now, while the US dollar is weakening, we're seeing some strength in things like Bitcoin and crypto. So I put the very long-term picture up because I always try to keep things in context. Get a huge run up into 2014. And then you had 2.5 years of sideways. And in fact, Bitcoin went down a little over 80%. Then you had a long run up and another period of time where Bitcoin came off about 80%, worked its way higher, and then sharply higher. Well, we know that this went through a correction the same time the stock market did, again, down 77% to the low point. But since then, and against a lot of bad news, working its way higher. And if we look at it sort of on a year-to-date basis, 2023, nothing wrong with this. So there is slow adoption taking place. We just want to keep it on the radar screen. I would say in general, that's improving. Okay, so now we don't make decisions based on economic data, but we do like to understand how it might be impacting us in portfolios. Now, through the first quarter of 2023, the earnings surprise was about 6.6%. So the average company beat earnings expectations or analyst expectations by about 6%. That reversed a series of declines that had happened over a number of quarters as analysts were taking their numbers down. Perhaps they got too aggressive about taking their estimates down. So what are we seeing now? We're headed into the second quarter earnings period, and strategists' earnings per share estimates are rising. So now remember, there's a lot of folks pointing to a recession that still has yet to materialize. And not to say it can't, but we have to look bottom up to say what's happening in our earnings estimates, and earnings estimates look like they're headed higher coming into this quarter. In fact, if we look at the earnings estimates from over the course of the year, they were falling, rising, and now rising for 2024. So not to say they can't go lower, but estimates are expecting earnings growth for the quarter. And when you look at what's happening in the market, it's kind of interesting, because what we see is that price tends to lead earnings. So in other words, the PE that investors are prepared to pay comes down as you go through a difficult period. What you see here, earnings per share growth falling as estimates are cut. But at some point, people start to pay a higher multiple of earnings as they expect earnings to start going back up again. So we've seen the PE start to expand while we've seen earnings growth flatten out. We know that they've started to estimate higher earnings. And look what's happening to stocks. Stocks are sensing and looking beyond the present, looking beyond the earnings revisions lower, perhaps expecting things to get a little bit better. And we know that there's a ton of money that went to the sidelines and people that were short the market. At some point, after many, many months of being short, they're starting to cover, but they've only just begun. When we look back at periods where speculators started to cover shorts, it then went on for months and months and months and months. Now, that doesn't mean it has to be the same this time, but I would say that positioning got exceedingly defensive, expectations got exceedingly pessimistic, and now equity sentiment is starting to improve. And again, once it starts to improve, it often improves for longer periods of months than just one. So sentiment getting a little better, positioning started to get a little bit less defensive, earnings expectations a little bit less negative, and the stock market's responding. It's why you can't wait for good news. You have to watch for the market signaling. Now, look, everybody makes decisions their own way. We believe that 70% return comes from getting to the right neighborhood, the right asset classes, like say equities or commodities, maybe avoiding certain asset classes like, real estate, which have been really, really weak, finding the right sectors within those groups, and then finding securities that are good getting better. We run our top-down process looking for areas of the market that are showing improving breadth for better and better participation. And we run bottom-up security selection looking for companies that have financial characteristics that point to something changing for the better. In fact, we're looking for good getting better. From a top-down perspective, we're always looking for the group where almost nothing's working, but then you see more and more companies start to participate, and you go through a cycle. When breadth is expanding, that's a healthy thing. When breadth starts to contract or the weaklings start to roll over, it tells us maybe the tide's starting to go out. We should be a little bit more cautious. And so these are groups we try to avoid, and we stop putting any new positions on, and we run stop losses on everything. So at the beginning of May, breadth in the US had been weakening, and had been weakening over a 6 or 7 week period. It means that we weren't putting on new positions. It means we were being a little bit defensive with some extra cash, and the short-term indicators were mixed. We talked last week about the fact that the long-term indicators have improved, and they continue to improve. So it means we are more generally positive. From a breadth perspective, from a sector perspective, the beginning of, May 26th, a month ago, the average sector had 35% of stocks in uptrends. You can see there are a number of them that were in small letters, meaning breadth was contracting. As we sit today, we've moved to the right. The average sector has a higher percentage of stocks in uptrends. It means that more stocks are participating in the rally. That's exactly what we're looking for. So a month later, on average, by sector, 7% more stocks in uptrends. You can see very few sectors are seeing contraction. Things are improving. So let's talk about leadership for a minute. Technology has been sort of the star over the course of the year. A lot of companies in the XLK index that are the very large cap tech, big winners over the course of the year. A lot of them, partly because of expectation for opportunity in AI. And we know semiconductors have been very strong, and semiconductors are the most cyclical part of tech, the most economically sensitive. They've had a great run off the bottom. Now, we spent time talking about how we have tried to participate in AI, starting kind of with the picks and shovels. And James, I think, is going to come on and we're going to talk a little bit. To his credit, he really pushed us to build a new position in NVIDIA, which of course we've owned before, but with a view that this could be a big participant. James, maybe just touch on that a little bit. We've been doing some research on a bunch of sectors, but tech is the obvious one. Sort of what were your thoughts here?
Yeah, absolutely, Dave. Thank you. It's been an area that we focused on for a long time. I think call AI what you like, but in recent memory, it was a focus for us in 2018 and 19 with the advent of computer vision for autonomous driving. So at that time, we saw a lot of benefit in the semiconductor names, namely NVIDIA. So this time around, obviously the magnitude is larger with generative AI. It'll just have a bigger impact to these names. So
tell me why in particular do the chips seem to lead in the adoption of a technology cycle?
So the way that we've been thinking about the AI cycle is that right now we're seeing the chips lead because there's a lot of investment by some of the mega cap tech companies in the US to build out products. Because generative AI is so computationally intensive, you just need a ton of chips to be able to do it, to train the systems. So as many H100 data center GPUs that NVIDIA can make, they're being sold into data centers and purchased by the large cloud service providers to train these AI systems right now.
So if a company was testing a large model that they wanted to use for predictive purposes, and it was going to take 2 months using 500 GPUs, can they cut the time dramatically by using 2,000 GPUs?
They can. So in this case, the compute scales linearly. So if it would take you a week on 1,000 GPUs to train your system, you can cut that. You can cut that in a linear way by the amount of GPUs that you're buying. So it companies that are willing to move fast, and obviously there's an advantage to moving fast in this industry, and have the money to spend, are buying as many GPUs as they're able to right now.
So the obvious economic winner at the beginning is the one selling the tools to start building these large language models. Now, so obviously that supports why chips have been so strong so far in the year. And believe me, I wish we had a bigger position in NVIDIA. We all do. But, to your credit, you pushed us here. You pushed us into other semiconductor companies, and you really pushed, on the infrastructure platforms, providing the infrastructure. Talk a little bit about this timeline and how it might, flow from here. And are there a lot of small companies you think that will benefit that are obvious, or, is it too early for that?
I think it's too early. The big winners of AI, they may be small private companies right now. They may have not even begun operations, because obviously this is going to play out over the next, decade or even longer, the benefits. So I don't think at the beginning of the internet you would have expected the winners to emerge that did. So, it's something that we're staying close to and trying to keep up on from a research perspective. And as we've moved, as we've broadened out our exposure to AI from beyond just the semiconductor names, we've been adding a lot of the large cap US names that are benefiting as they've invested to build these products. Now we're starting to see these products start to come to market, and they're able to monetize them. I think that's where we are right now. Where we go from here, who knows? We've been spending a lot of time focusing on what that looks like for really any industry. So maybe Dave, we can go to this slide. Yeah, we borrowed this slide from Morgan Stanley that have done some good work, just on, across multiple sectors, what will be the impact as these AI products start to roll out. So just some, I encourage everybody to read through these points because it is good research. Some areas that jump out at us, there'll be things that every company should take advantage of, like business intelligence. So those are things like process automation, fraud prevention, increasing cybersecurity capabilities, data analysis and predictive modeling. AI proliferation and generative AI will help with all of those aspects. And things like customer service. In a few years, all call center processes should be underpinned by AI. Industries like advertising will be seriously impacted. So generative AI content will proliferate, recommendation engines will improve, ad targeting attribution will improve. Even some industries that you wouldn't expect, there are use cases like in the energy industry. They can start to do reservoir optimization, enhancements to energy trading, things like labor scheduling. In the transportation industry, there are opportunities like supply chain management and truck routing capabilities. So, it's something that we're spending a lot of time thinking about, and the opportunities are so broad for these companies. So
it's really interesting. We were talking earlier about just how much time and effort, we've been spending looking at each of these industries, because for all of the companies that are going to execute and use these tools effectively, there's a whole bunch of companies that are going to be disintermediated and have destruction in their business models. So, one of the things that we've been thinking about is just how important it is to look company by company and industry by industry to stay focused and make sure that we are in groups that are, going to take some benefit and take advantage, because really it's the use cases are so broad, and the potential disruption is so significant that really this is going to be an area we are going to be focused on for a long time.
And I think a name like Thomson Reuters speaks to that. We're concerned with, the companies that are going to adapt and who's going to get disrupted. I think if we were to have this conversation late last year, there'd be a good argument to be made that their business would be severely disrupted by generative AI proliferation. Specifically the legal segment. So if a company like OpenAI were to target that segment, they'd be able to pretty quickly come up with a product that would allow you to churn through a ton of legal data. You can do it to an extent right now in ChatGPT. Of course, there are some issues with the data integrity right now. So the business was at risk, but we've seen that company lean into it. They're almost at the cutting edge of AI right now, and in Canada, it's one of the few ways to play the theme in public markets. And so this morning we saw them buy a company called Case Text, which acts as an AI assistant for the legal industry. So through it, you can search through cases, you can ensure that your client files are compliant, and that's underpinned by OpenAI's GPT-4. So I think that their business was at risk. They leaned into it, and now they may emerge a leader and a beneficiary from AI.
Right.
And that's
well,
our
James, thanks so much. We're going to
position.
wind up coming back to this topic, I know, a number of times, because lots of people have interest in it. And certainly we think it's going to be an important consideration in any of the companies that we invest in. So thanks very much for taking the time today.
Thanks for having me, Dave.
Okay, well, not quite as sexy, but we got to move on. We'll look at other sectors. We keep trying to look at groups in context to expectations of an economic slowdown. And of course, we've been spending time looking for industries that we think actually have a significant secular tailwind that goes beyond the cyclical, business cycle. One of the areas that we think is really interesting is the whole concept of reshoring industry to try and reduce the amount of risk that companies have to their supply chain from overseas. A lot of companies in the industrial sector really bottomed early, well before the market bottomed in October. And this would involve some of the defense companies for obvious reasons, but also some of the machinery companies. And when we look at an equally weighted basket of industrial companies, we're making 52-week highs. And in fact, the industry is higher than where it was at the beginning of the bear market. Doesn't really point to a big negative impact from recession, but certainly the view is that there are real tailwinds within this group, especially in the machinery and automation area, but equally weighted industrials are making new relative highs going back over multiple years after underperforming for many years, really outperforming. This is an ETF that we own in our macro portfolio. It's made of mid-sized industrial machinery companies, a lot of them in automation, but making us a series of higher lows and trading at 52-week highs. Companies that make machinery for a smart grid. We know the EV is coming, demand for more electricity is coming. Utilities are having to scale up their networks to be able to balance loads and deliver for all the demand that's going to come from electric vehicles. And there's been a bunch of investment here. Transportation, a very economically sensitive group, trading at 52-week highs and now trading basically above where the market was at the beginning of the bear market. Going beyond industrials, consumer. Now, this is a group you would expect to have a really hard time with the massive increase in interest rates and mortgage rates. This group bottomed in June of last year, made a higher low in October. That's something we watch for. The market always gives you a sign as to what it is that may have strong relative performance. They tend to bottom early and they tend to rally well. We look at this ETF, the ITB, which is made up of home construction companies and materials companies, was $50 in October. It's $85 today. We were sharply higher today on the day. This ETF is up 40% from the beginning of 2023 and up 2.3% from the highs in the end of 2022. We've got Pulte Homes in this group. This is one of our major holdings, moving smartly higher. Demand for new homes seems to be very, very strong. And BH Horton, both of these focus more in the Southwest in more mid-priced homes. Steel, again, a group that you would expect to have a very difficult time when the Fed is raising rates sharply and the expectation is for a global economic slowdown. This is the SLX ETF. It's up 43% since the bear market began, despite the Fed cycle. Now, it's a little testing our patience because it's been moving sideways here now for a year. But my guess is we're very, very close to 52-week highs. We've come out of a multiple period of years going back to 2012, where the group was in a trading range. As we get up and out of this group, it gives us a reason to be patient because likely it's the beginning of a new bull market. Copper is very similar. After a very long bear market, 2013 through 22 broke out and has been consolidating since the beginning of last year and has lots of up and downs, but up 7.8% since the beginning of the bear market in 2022. A couple of names that are working for us: Vulcan Materials and Martin Marietta, misspelled Martin Marietta, both in the aggregates industry being used for road building and lots of money being spent on infrastructure. Natural gas producers and energy producers are in that same situation, a long consolidation. It is tough to wait, but we know when they start to move, they move quickly. And financials are a similar picture. A bear market that started in 2008 broke out and has consolidated. None of these things look like what you would expect if you're headed for some major financial calamity. And the reason I put this long-term chart up is this is what a financial crisis looks like. 2008-9. Now, no matter which way I squint at this looks nothing like this. Now, if we were to break down, and there was lots of negative news a couple of months ago in financials, well, we would have to take a look at it. But at this point, it continues to consolidate. We continue to get paid our dividends. And in an economically sensitive cycle, longer term, we should see good dividend growth here. Last couple of points. High beta companies are reacting very well. That's high economic sensitivity. Few days down during the week that was weaker last week, and a sharp move higher today on the first sign of strength. Let's compare that to companies that make up the low vol ETF. Consumer staples and healthcare companies, PepsiCo, Johnson & Johnson, McDonald's, Coca-Cola, Mondelez, Hershey's, Merck. These are the companies you'd expect to be doing well if you think there's a recession coming. And we can see this blue line relative strength has been falling steadily over the course of the year. So the market does not support the idea that the place to be is in defensives. So looking at our firm-wide exposure, not changing dramatically. Technology continues to be our biggest weight. We do have an overweight position in financials because we think we're going to see good dividend growth. Significant overweight in industrials. We do have some dry powder in bonds and cash. And then at the other end of the spectrum, a significant underweight in utilities, real estate, staples, communication services, defensives. Energy materials are an overweight and an underweight in healthcare, which also is defensive. So the market is slowly unfolding. There are some really clear areas of strength, and there are some areas that have big technical structures that can support moves significantly higher. Groups that are very economically sensitive, but been very, very resilient against what's been happening in the perceived what's happening in the economy. Last couple of points. Canadian dollar gives us reason to be bullish. It's broken above the range it's been in going back to October of 2022, working its way higher. Probably a little bit more work to do here, but in general, we lean towards the Canadian dollar and in our pools and funds hedged back to Canadian dollars. And now we head into this June to July period, which tends to be positive when we come into it with a pretty positive stance from our breadth models. But we think that we continue to be in a structural bull market. We continue to be above this rising 200-week moving average. It is frustrating that some big groups have been moving sideways, not higher, while tech has been moving higher. But economic concerns don't resolve overnight. What we can say is things across the board in general are improving, other than things that act like bonds, where we really don't have a big position. We're very happy to get defensive if things start to roll over, but seasonally and from a breadth perspective, from an earnings perspective, from a positioning perspective, and from a sentiment perspective, we see things generally getting better. So with that, Pamela, if there's any questions, certainly I'm happy to answer them. But the fact is we'll continue to take new data as it comes. And of course, we're about to get a bunch of earnings data, and it'll be interesting to see how the market reacts.
Thanks so much, Dave, and thanks, James. Always nice to see you on our Tuesday night program. Dave, the first question comes from Alejandro. He says, good afternoon, David. As per your bear view or flat view on bonds, do you think the next move of the US curve has been inverted more than 100 beeps, 2-year versus 10-year? Do you see a bear flattening in the next year? Assuming the central banks won't cut rates for the longer part of the curve, will it go above 4% or 4.5%, perhaps? That's coming from Alejandro.
Okay, so let's see if I can share my screen here. Okay, so there's, let's just start here, TLT. So this is, the long bond ETF. If we're looking at it from a time perspective, this is sort of from the highs. Let's take a look here. Okay, we'll make it even a little bit longer. Okay, back to 2020, March. There's the high. So we made a series of lower highs. Long-term moving averages moving lower. When we look at it in the near term, we broke below this consolidation range, unable to get above from a price perspective. Now trading below all the moving averages, and sort of things like the MACD is trading below the signal line, and very weak relative strength. That to me is not something I would make a bet on for a long position. If I were looking at 10-year yields, looking at it the other way, certainly we consolidated that initial move higher, and the most likely outcome is that we would take out these highs. Now, it doesn't mean that is what's going to happen, but it means that that is the most likely outcome. Given the fact that we've seen such weak performance in defensives, which are effectively bond proxies, sectors that pay a big dividend without a lot of growth, given the fact that they have been relatively very weak also, this whole yield area looks like the expectation is yields can go higher. Now, if you listen to the economists talk about recession, you might expect that inflation is going to go right back down again. Maybe we even have disinflation and that yields would fall through the floor. And I understand it. That's what people are betting on, all those flows into bonds. But at this point, the bond market isn't buying it. Now, there's other dynamics at play. Some global players have been reducing their exposure to US bonds. I think that's a truth. Certainly, there's concern around the amount of issuance that the US Treasury is going to have to do to refill its coffers after the passing of the debt ceiling extension. So that's a concern. So between the issuance and less demand coming from outside the US, a weaker US dollar, maybe that points to investors coming to the view that rates actually are different than what they've been for the last 40 years, where every time you had a rally in yields meant bond prices pulled back, it was time to buy them or buy the dip. And I think that the picture is very different today. I think that we really did see a major structural shift from a world of, lower lows and lower highs in yield to more likely higher highs and higher lows. And so I just don't see a case to go and get really exposed to fixed income other than, the very short end of the curve where you're just looking for a place to hide and get a nice yield. And even then, the taxes and inflation are still kind of eating up your return.
Thank you so much, David. The next question comes from Stephen from Toronto, Dave. He wants to know a little bit more about financials. He says, David, here's my question of the day. Financials, broadly defined, very strong last 2 to 3 trading days. We haven't heard any explanation for this. Do you have any simple answers?
Look, I think in general, like if let's just take a look. Let's look at the groups. Sorry. Let's look at groups. So, XLF is a broad-based group. We made low in March. We made a higher low in June. This, of course, includes the regional banks. It includes the large banks. It includes insurance companies. It includes financial technology. It involves the custody banks. There's a whole bunch of different constituents here. The big problem has been the regional banks. And, there's not much to do here. We've said over and over again, we have really no exposure to regional banks. They put in a low in March and in May, and they're a little bit better here today. Technically speaking, hard to get excited about that. Even the large banks ETF doesn't look a lot better. On these webcasts, we've talked a lot about wanting to own the best of the best, like JP Morgan, looks really different. And in general, the biggest, safest banks have been taking market share and they look more attractive. As we go along, the banks that have been able to grow their deposits and are now having loans roll over at higher interest rates they're starting to see improvement in their net interest margins. And that's a positive. You could say on JP Morgan, after consolidating in a tightening range, it broke out to the upside and sort of pulled back to the moving average. I think that that's generally positive. We think that the insurance companies are probably more interesting. The returns have been pretty good there. And the group is improving. When you put it in context, the very long-term picture, I keep trying to make sure we're watching the very long-term picture, because when a group comes out of a bear market like this, even if it consolidates for months and months, that started a new bull market. So there's obviously cyclical economic concerns right now, but the fact that it's acted like this, not like this, tells me that we're not headed into the kind of Armageddon that people remember so clearly in their minds about the late 2010s. So my guess is at some point over the next few months, we're going to see this, break above this downward trending line, and likely we get good returns. In the meantime, we've talked about this in-house. Some of the dividends that are being paid by some of the Canadian banks, are really, really attractive, and they got pretty good balance sheets.
Thank you so much, David. The next question comes from one of our viewers, not giving him his name this time around, but he says he often hears that energy is a late cycle asset. Do you agree?
Yeah, I think that we're in a really unusual time. I mean, there's been so many cross currents. You've got the geopolitical issues with Russia and where their oil is going, where it's leaking out to. You've got, people who have looked for years at the fact that at some point, maybe we're not going to need oil. I think that's a long time away. We know that when you look at the XOP index, again, the very long-term picture, this was a horrible bear market, 90% decline from 2014 through 2020, 90% decline. So, the group has rallied, it's consolidated over a number of months. We know that some things are going to change. We know that in the developing world, the growth in consumption is outstripping the savings that we're seeing in the developed world. We know that because of this very poor period for the shares of energy producers, boards of directors held their management groups back from spending any more money developing more properties. So we know that there's not a lot of spending going on to bring new supply online. And of course, there's concern right now about economic slowdown, and a lot of financial players would use energy producers or oil as something to bet against. The paper market for oil is actually bigger than the physical market. In other words, speculation is a big part of what moves price. And my guess is at some point, people who have been shorting are going to have to wind up covering. But, we got to wait and see that happen. This big consolidation is going to break one way or the other. It's going to break to the downside or going to break to the upside. What we've been seeing in commodity companies in general is they've been breaking out of these big consolidation ranges to the upside. So my guess is that's probably the direction we're going to go. The natural gas producers, look more attractive. It looks like they have started to come out of this range. We're testing from the top level now. We'll see where things go. But given what's happened in uranium, given what's happened in the agriculture producers, given what's happened in steel, my guess is all of these groups are going to resolve higher. And what has seemed like quite a long wait over the last number of months while the Fed's been raising rates could get paid for very quickly as they start to go.
Thanks so much.
In the meantime,
sorry,
if you look at something like Gunner, GUNR, which is an ETF made up of, energy producers largely, they're big dividend payers, and you're getting paid well to wait. And this is not acting like a recession is about to take it down.
Thank you so much, David. The last question we've received comes from Lawrence. And this question could also be posed to James if he's still there, because it relates to AI and SMCI. So Lawrence is asking, what are your thoughts re SMCI? It seems to be involved in all the AI winners. Any thoughts there, James? Or David?
Right,
You know,
SNPI.
Oh,
it's
SMCI.
SMCI. You know, it's truthfully not
Oh,
a name
yeah,
that
yeah,
we've been
yeah, yeah.
involved in. I don't know the name well enough to comment on it.
Fair enough.
Yeah,
All right.
I mean, you know, it's obviously got a great chart, but I haven't spent any time on it whatsoever.
Fair enough. All right, Lawrence, we will do some work on that and get back to you. So send me your email. Send me an email, phastings@barometercapital.ca, and we'd be pleased to get some information to you. And on that note, David, James, always great to see you. Thanks so much for your time. David, I'll leave you with the final word.
Yeah, look, I think that we've now been 18 months in a very sloppy market with lots of things to worry about. I'm going to say 18 months feels like a long time. And while our view is that things have been improving, and they have been since October, it's not happening very fast. I think that, I guess my message to most people would be that the hardest thing in investing is having patience. I'd love to say we piled all of our portfolios into the 10 top stocks in the S&P at the beginning of the year, but probably that wouldn't have made much sense. It would have been very profitable, however. But I would say that as these kinds of markets resolve, and some sectors will resolve faster than others, you know, the opportunity far outweighs the risk at this point. So if we're getting a growing stream of dividends, and we've got things generally improving in the right direction, you know, this is taking some time to resolve, but it will resolve. And, you know, where the opportunity lies is in the 3 to 4 years that follow a cyclical bear market. And there will be lots of returns to be had over that period of time. So we're going to continue to try and find the places that do have a good risk reward setup, and have some patience. So thanks very much. We'll look forward to tuning in again next week. And please send us your questions in between if you'd like us to make sure we cover them. And if you'd like to jump on the phone, give us a call. Anyway, I hope everybody enjoys the summer. And thanks, Pamela, very much for moderating.
Always a pleasure. Thanks, guys.